Good afternoon, Mr. Don Simmons. Thank you very much for doing this. I really appreciate your time.
Glad to be here.
For the listener, you're the CEO of Hemisphere Energy, but what is Hemisphere Energy?
Hemisphere, well, we're a 3,000 to 4,000 barrel a day Canadian heavy oil company.
Headquartered in Vancouver, British Columbia, I think.
That is correct, yes, which makes us a bit unique, but that's correct.
A little bit unconventional. In fact, you're taking a flight home tonight after this conversation, but it appears to be working.
Oh, yeah. I mean, I would say at the beginning, there were people that wondered if you could run a company from Vancouver. Certainly, some eyes rolled when I was in Calgary now and then, but no, it's been great. I always say the management team's all there, head office is there. We're all a bunch of Calgary expats that were trained here. Mostly at larger companies, and then ended up in Vancouver for one reason or another. And we do come back and forth as much as needed. Sometimes I'm here every week in a month, and sometimes I go 2 or 3 months when I'm not here. But it's been no problem.
And for context, a market cap of approximately $200 million, boat 3,800 BOE a day, which is 99% heavy oil, I think.
Correct, yes.
So you're growing. Rare junior company in the sector nowadays.
There's not many of us left, that's for sure. I mean, back, 10 years ago, 15 years ago, there was probably 70, 80 companies like Hemisphere, and now there's a handful.
To go back to the beginning, originally, I think you're from out east in Ontario, went to school at Queen's?
Correct, yes. I grew up small town Ontario, went and took a geology degree at Queen's, and basically the day I graduated, I drove west to Calgary and started with a contract position at a company called Alberta Energy Company, which then later became EnCana, Cenovus, and Ovintiv.
Were you always planning to work in energy? Was that the plan?
No. I growing up in a small town, kind of was more mining oriented in the Canadian Shield. But always had kind of a love for rocks. And that's what kind of led me into geology. And what really then led me into the oil and gas business and the energy side was a trip that is organized by the Canadian Society of Petroleum Geologists once a year. They bring, it's called the SIFT trip, or the Student Industry Field Trip. They bring one student from each geology department across Canada out to learn about the oil and gas business for 2 weeks. So I was selected after third year from Queen's to come out to Calgary for those 2 weeks. And after 2 weeks out here, learning about the business, I knew this was something that I wanted to do for the rest of my life.
So that would have been in the 90s?
99. Yeah, that's correct.
Packed up your car and drove out to Calgary?
99 is when I came, and then 2000 I graduated, and packed up an old Ford Tempo, and it managed to get all the way from Ontario to Calgary.
So that would have been after you graduated in the spring?
Correct. Yeah, and started in May, and had a 6-month contract and as a geologist, and that led to a full-time position in the fall.
And so at the time you were thinking to yourself, I love geology, and the oil and gas business seems like a great place to make a career. The idea?
For me, yes, that's which was unique at the time. I don't know if you remember, but the late 90s wasn't a great time for oil. I think it hit a low of $9 a barrel. So going into geology and geared towards oil and gas, I was the only geologist at Queen's at the time that went in that direction. Other of the geologists went into hard rock and mining. One became a lawyer, and some environmental geologists came out there as well. But it didn't really occur to me that there wouldn't be opportunities, and really, other than COVID, that was a low point for oil prices. And through my career, I've seen a fairly steady increase in production in Canada, and better pricing as we've rolled along.
Was your plan always to be an entrepreneur? What were you thinking?
I wouldn't say that. I love geology. Love the days I get to do geology still. So I started at a larger company. AC was kind of a mid cap, I guess they'd call it back at the time. And then, but it was big enough that it did a lot of training. So it was a great place. It had a great culture, kind of a work hard, play hard culture, which, for someone's just starting, had all the opportunity for the different courses and training. I had great mentors that, some of which, even had lunch with one of the guys today, some of the people I still work with. And so just a phenomenal opportunity. And then I went, I did know after, working at a large company, I did one day want to try working at a smaller company. And so I did leave EnCana at the time after working some international that went to a small private company. And I worked there until it was bought out. And at that point in time, my wife got married. My wife got a position at the Children's Hospital in Vancouver. It's why then I packed up from Calgary and moved to Vancouver. And that's where, Hemisphere got started from some discussions there.
So you went from AEC to a private junior oil and gas company.
Correct.
And was that a career risk? Did you have to put money in? What were you thinking?
Did put some money in, and it was a good learning lesson. I didn't make a lot on that investment, and did really learn, sort of the ropes of how this business, the risk in this business, and so it was one thing where. I think I learned to be a bit more cautious on capital spending and knowing not taking some of that for granted. I mean, it's as a geologist, you're trained. You gotta dream. You gotta analyze things, but risk is part of this business and it's part of being a geologist. But it's calculated risk, and I think that being trained by engineers at AEC and EnCana probably helped form that, the calculation of the risk for my career.
So that would have been mid-2000s?
Exactly. Yeah. I think I was at AEC and EnCana. So I worked Southern Alberta and then I worked Ecuador with EnCana until around 2006. I went to the small private for about a year and a half till closer to 2008, 2007, 2008, and then moved out to Vancouver.
And you were able to sell the company during the financial crisis.
I guess it would have been through there. Yeah, it was a natural gas. We weren't that big. We were probably 500 or 600 BOEs natural gas, and we were just kind of in the way of a larger company that was acquiring at the time. So gas prices were still, I think then they were down to around $5 or $6 an MCF. So quite high compared to today's numbers, but in hindsight, it was probably good we sold when we did.
Which led to Hemisphere. So maybe for the listener, how did you get involved with Hemisphere and why?
Moving out to Vancouver, I knew there was not a lot of oil and gas geologist opportunities. So the one thing I did do a quick search, try and find some companies that might need some help. And that didn't seem to really work anywhere or find anything. But I ended up golfing with my father-in-law. He took me out for a round of golf. And at the golf club, he introduced me to the chairman of Hemisphere, Charlie O'Sullivan. And, he had this little company. It was basically Shell. It had 10 BOEs of halfway natural gas from Northeast BC. And they really didn't have technical help or anybody in the organization to really try and move the company forward. So we had a couple of coffees, discussed it. I didn't really have any other opportunities out there. And we took it on. It had a bit of money in the bank, had a publicly traded, Shell and symbol and a little bit of cash flow, but not a lot. And that's how it really, bloomed from there. And then it was, kind of rolling the sleeves up and digging through opportunities. I really went back to where I started my career down in Southeast Alberta and started eventually to get a few deals down there. And as the oil business goes, lots of ups and downs with pricing and access to capital. And, I always say this is kind of the longest 5-year plan, I've ever had. And we're, 15 years into it. So, and still going, but it hasn't been a smooth path for sure.
So your wife went out to medical school in Vancouver and you thought to yourself, I need to find a job or start a business in a nutshell?
Well, she actually was done med school,
Okay.
so she was coming back and had a residency position. Yes, and I did need to find a job. I did need to make some money and support starting a family. And the one thing I know how to do is look for oil, and this Hemisphere provided that opportunity.
So that would have been 2010, roughly?
Yeah, I'd say our first kind of deals and stuff that we started to do was 2010, 2011 is when we kind of got things rolling. Yeah.
And so at the time for Hemisphere, what was the value proposition, not only to investors, but to yourself? What did you see as the point of putting your money into this company?
Well, you were basically betting on, at that time, myself and a few other people that, that I had worked with in the past to try and grow a business. I mean, this was at that point in time, probably a $5 million market cap type, shell with a little bit of, few assets in it. And, we literally would pass the hat around friends and family for the first $500,000 here and $1 million there. I don't recommend doing it that way anymore, but that's how we did it. And then we got some support once we got, we did drill a couple of good wells. We did a couple of decent deals. And then we did start to get a bit of a backing from some of the brokers in the area, more the retail brokers. And, that allowed us to do a few more deals and buy a few more assets and build the company that we have today.
This episode is brought to you by Ambient. Ambient helps energy leaders improve production performance and expand margins through AI-powered optimization. Built on trust, transparency, and collaboration, the Ambient platform turns data into confident decisions, delivering measurable operational impact. Find out how Ambient expands the capacity of your production teams at ambient.com. So you had about 10 BOE a day of natural gas production, and did you drill first or did you buy more production?
So no, we drilled. The next was a farm-in that we did down in southern Alberta, back to some assets that I had mapped when I had worked at AEC back in the day, and we weren't able to acquire them at the time, but I was able to do a farm-in, and then that led to some more production, and then that led to being able to acquire those assets. And as we kind of grew in that area and got to know some of the players in there, some of the bigger companies, they weren't that active. So I'd identified Atlee, our main asset now, as something that we wanted to acquire, but it wasn't for sale. So every time I would meet with the company that owned most of it, I'd say, hey, what about this asset? Over in Atlee, and they'd say, oh, there's an old geologist that likes it. It's not really for sale. Mm-hmm. And then one day I got a phone call and they said, hey, Don, that asset you've been bugging us about for years. We've been told to sell everything, and anything we can get a good bid, get your bid in the next 2 weeks, highest bid wins. Mm-hmm. And we ended up buying 20 barrels a day for about $3.5 million, which seemed expensive to most people. It was pretty much every dime we had plus could borrow. Mm-hmm. We kept enough to drill one more well or one well into it, and that well was successful, and that was the start of our development in Atlee.
Those first wells you drilled when you farmed in, was that a big risk for you? Did you have to do kind of 2 or 3 well program? How did that go?
It was one well at a time, which was nice. We only were committing one well. So if you drilled a well, you earned something and then and moved from there. So there's always risk. I sat those wells back in the day. I'd sit on the rig and up all night as we'd make our decisions as we're drilling. As a company, we either myself or Andrew Arthur, our VPX, have sat pretty much every well we've ever drilled. It's just a thing now. So yeah, there's risk. Everything was on the line. That's why that's why I was there. I mean, every decision could have been either the anchor that took you down or the next cash flow that kept you going to the next well. That allowed us to, like I said, do an acquisition. We were able to raise some money around that acquisition. And then that led us in those assets. Those were in our area called Jenner. That then led, and those people we were meeting with led to the Atlee Buffalo assets that we currently have been producing and developing over the last, I'd say, 5, 6, 7 years.
So those first few wells panned out.
They did. They panned out well and kept us moving to onto the next asset. And that's kind of the nature of this business. You can't stand still too long. You got to keep continuing to move things forward. It's a depleting asset. You're cashing in your oil every day, so you want to take some of that cash and be investing it for future cash flow.
And did you have a plan B if it didn't work out at Hemisphere?
No.
What were you thinking?
There was definitely no plan B back in those original days. It was all chips were in for sure. Yeah.
Mm-hmm. And somewhere along the way, you ended up with the Atlee assets, which is what you have now, the main focus of Hemisphere. So you mentioned it sort of already, but at that point, were you thinking we'll focus on this once you got it?
Absolutely. So those were assets that I had known about and had wanted for a long time. And so being able to get our hands on that through a few different deals, we knew that there was a lot of oil there. And we knew that not a lot of the oil had been taken out. So we didn't discover these assets. They were discovered in the late 70s, early 80s. Mm-hmm. But they only took out about 2 or 3% of the oil that is in place in these pools. So we knew that there was a prize, but the risk was how much more of that can you get out? And what do you need to do to get it out? Mm-hmm. So it's heavy oil. So one thing that through my experience and some of the rest on the team was to bring in horizontal wells. 3D seismic, and also water flood is what we started with. And that was, working quite well. We were recovering a lot more of the oil that was there. And then it was really then COVID and the scare of oil prices and how much they fell there. It was survival for a year. We didn't drill any wells. But one thing that we looked at, we said, well, we've got all this oil in place. And we know we're only going to get sort of, call it 20, 25% of that oil out with a water flood. How can we get more of this oil out? And I had been involved in that general area with some other polymer and some ASP floods back in my days at AEC and EnCana. And so we started to look at that. My memory of some of those floods was that they were very expensive, and I didn't think we were going to be able to do that as a small company. But as we dug in and kind of talked to the experts, and we looked at more analogs around Alberta and Saskatchewan, we actually realized that we could do this. The modeling that we did on our reservoir showed that it should be a really good reservoir for polymer flooding. And so we managed to talk to our lenders at the time and talk them into agreeing to give us a bit more money to attempt this, even through COVID. And as the timing worked out really well as we kind of started to see a response in those floods, as right as we kind of came into late 21, 2022, as the price started to come back to $60, $65 WTI. So it's been a great asset. It's a phenomenal asset, and will be the engine and cash flow for our company for years to come.
So you identified the assets when you picked it up. Heavy oil, lots of oil there, and through enhanced recovery, you could increase production. And that was your value prop to yourself and to investors?
Yes. Yeah. At that point, we knew we had a prize, and it wasn't easy. Like we acquired that asset through a few different, there was a couple of different deals, but kind of 2014, 15, 16. And it took most of our money just to acquire and test to make sure what we were buying would work. And then, I don't know if you remember back then, but WTI might have been okay, but then the diffs blew out because we didn't have the egress and the pipeline. So you'd have a $50 or $60 WTI, but you'd have a $20 or $30 differential. And so it was tough as heavy oil. So we really just limped things along and made sure we didn't take on too much risk or too much debt to put ourselves in danger. But it was extremely hard to find capital. We looked at everything. Was there something we could sell and raise enough to do it? Could we, get a GOR? Could we raise capital? But we were trading at, 10, 15, 20 cents. I mean, to raise the capital we required, 10, 20, $30 million was going to dilute all of our shareholders, and it would be hard for anybody to make money at the end of the day. So we were quite fortunate, again, through sort of it was a trip like this to Calgary, a 1 or 2 day trip. I was pounding the pavement around town, talking to everybody I could to come up with some way. And my phone rang as I was on my way to the airport and saying, "Hey, can you do one more meeting?" And I said, "Yeah, I can." And had one meeting, sat across from a couple of guys that were kind of like us, a small company, but they were small on the lending side. And we had a great meeting, and that led eventually to us doing a debt structure that allowed us enough capital to go drill the wells we needed to and build the facilities and the pipelines to really get Atlee up to a critical mass and cash flow, which for us was, it was around kind of 1,500 barrels a day was a critical production point, even at lower oil prices, that allowed us to get that free cash flow to develop and grow the business.
This episode is brought to you by Bedell Gas Compression. Proud to be recognized as an industry leader, Bedell Gas Compression specializes in reliable, custom-engineered natural gas compression solutions that support efficient operations. Backed by experienced field service and an unwavering commitment to safety and performance, Bedell is a trusted partner in the field. From flexible rental options to fully customized new builds, the Bedell team focuses on operational efficiency, safety, and long-term performance, helping producers keep gas moving where it matters most. Learn more at bedell.com. So some serendipity really helped with the company's fortunes.
Our business, oil and gas, there's a lot of serendipity. Now you have to be in the loop, and you got to keep up with technology, and you got to be continually, seeing and looking what's going on there. But that's a big part of our business.
You knew the oil was there. It was just a matter of how to structure the company to get it out.
In that case, yeah, like at that point, we knew. That's why we weren't giving it up. We weren't going to hand the keys off. We weren't going to give it away. Yeah. We knew we had something special, and we knew we needed capital, but the cost of that capital, at least to raise, even if you could raise it, no one would have ever made money. So, going. And I don't recommend it to people, but, as a, 5,000-6,000 barrel a day company, 500-600,000 barrels a day, at one point we were $30 million in debt. And a lot of people that would just look at it from the outside were like, you're not going to make it. Mm-hmm. But we were quite confident that we would need better pricing in oil and diffs. Mm-hmm. But we also knew that, there was a lot of oil, and there is a lot of oil left to get out of the ground.
And so what year was this that you got the money?
2017, late 2017. So yeah. And again, I mean, things were better from a downturn point of view, but if you dig into the numbers, I mean, diffs were not great through there. Yeah. And I would say we really started to get some momentum, and then COVID hit in 2020, which, like I talked about a little bit earlier, ended up being advantageous to us. We had all this time on our hands. We weren't drilling wells. And that's when we studied and really dug into polymer flooding, and which is, added tremendous value and is going to allow us to get even more of the oil out of the ground. Why you do that is really ultimately to recover more of the oil. Instead of getting now kind of 25%, we get 30, 35%. There's analogs out there in the area that have gotten, more than 40% of the oil.
So in 2017, the value prop again, what were you thinking, that you'd maybe pay a dividend to yourself, or hoping just to grow the company?
No. I mean, back then,
flip it,
dividend. You always build these things to sell. Absolutely. I mean, we'll continue to grow a great business, but oil and gas companies, they're all built to with the idea that someday you're going to hand the keys off to a bigger entity. But back then, no, small companies didn't do dividends. And we needed every dime that we had to grow the business and infrastructure, wells. And so, no, but then it was just getting that capital, and not diluting all of the shareholders that we had, so that one day, if this worked, then they would make a lot of money. And then the dividend really came as we've seen the entire industry has shifted and investor sentiment has shifted to more of a return of capital to shareholders and running better businesses. And actually, just had a coffee with another guy that I started in the business with, and he's running a great company too with this very similar business model. And you have to run great businesses. And that's, where companies back when we started, it was drill, baby, drill. It was, growth for the sake of growth, and probably not a real great return on the capital invested, and eventually not great returns for investors out there.
So getting into 2020, you had some time on your hands as the industry slowed down. Oil prices went negative at one point, but you started to focus on the polymer water flood technique. But maybe for investors, what is the polymer water flood technique, and why has it been great for the company?
Sure. Yeah. And it some people think it sounds scary, or, there's some big secret behind it. And it's not really that complicated. It's really just adding a powdered polymer to your water. So it's a souped up water flood, which we do all over the basin. You have to have the right rock. You have to have the right oil quality, and you have to have the right play type. So just an oil column. But all it is, you're thickening the water, making it more like an olive oil. You're increasing the viscosity. And so that polymer water, it pushes through the reservoir more evenly, and sweeps more efficiently the oil that's in that reservoir from your injection wells to your producing wells. So the things we look for in a successful polymer flood is you do get an increase in production. You get a decrease in your decline rate. And I'll come back to that in a minute, why that's so important. But ultimately as well, we've talked about a few times, you get more oil out of the ground. So we know the oil's there. We can map that. You know that there's all this oil in the ground. And for a little bit more cost and facilities, because there is the polymer mixing facilities that you are required, so a few $1 million. And there's the cost of the polymer, which is, in our case, also, a few $1 million a year. But you get multiples of that back out in getting more oil over time. So you get it out faster in some ways, and you get more time. Let's go back to decline rate. Why is decline rate so important? And this is why we love polymer floods. We love SAGD operations. Any kind of enhanced oil recovery generally means you have a lower decline rate, which means you have to spend less money in capital every year just to keep production flat. And so there's more free cash flow. Free cash flow is the real king. Free cash flow is what you can pay off your debt with. You can build cash with. You can make acquisitions with. You can buy back stock with. You can pay dividend with. So that is the holy grail of every oil company, is continuing to build that free cash flow. And that comes from a lower decline rate.
And so for simple terms, you have the producing wells, which pump the oil out of the ground day to day, but then the injectors off to the side is what you put the polymer down. It kind of acts as a force under the ground to get more oil out at the end of the day, in real simple terms, I think.
In real simple terms, yes, that's it. It's not on the edges, as you said. We actually have injector-producer pairs throughout the pool. So you're kind of sweeping throughout the entire pool. And in our case, our injection wells are just as important as our producing wells. The producing wells bring the oil up and make we make the money from selling the oil. But we wouldn't make that oil in those producing wells without those injector wells.
The other way that some companies have been doing enhanced recovery is SAGD, steam-assisted gravity drainage. Do you ever think about that technique?
love that technique as well. In that case, it's even heavier oil. So when I talked about, for polymer floods, there's a rock type that you need, there's an oil quality that you need. That's where the difference is. So for us, we're heavy oil, but not crazy heavy. And so once you get into requiring steam, you're much higher viscosities now. You're 20,000 centipoise to 100 and some thousand centipoise. So that's where you need to actually, heat that steam into the reservoir and basically melt that oil down into your producing well. So we don't need to do that in this case, and there's a lot more costs, capital costs up front with SAGD operations.
This podcast episode is powered by ATB Capital Markets. ATB Capital Markets provides financial solutions and strategic advisory services to help businesses thrive. With a track record of successful deal execution, ATB is a full-service investment dealer with a deep understanding and commitment to the industries it serves. Visit atbcapitalmarkets.com for more information. Polymer is a chemical which you add to water at the facility?
It's not a chemical. It's just it's a polymer, and it is so it's best known around the world, and the companies that sell it to us use the same polymer in water treatment plants all over the world to basically help filter the water. And so we're just mixing it in. It thickens that up. It's almost it's hard to describe, but almost like a jelly in some cases. And yes, it just we have our water system that, our oil and water comes from our producing wells, and it gets separated out. Our oil goes to sales and our water comes back through. We add in some additional water, and that's where we add the polymer to get then the thickness of the water that we want, the centipoise of the water that we require to then pipeline it back out to our injection wells.
You have to buy it from somebody. Is there ever supply chain risks for the polymer, and how do you deal with that?
No, I mean, there's enough people in Canada that do polymer floods, and the company we work with is one of the largest in the world. So we've had no issues, knock on wood, with having supply, and we do. Typically out in the field, we have enough supply for numerous months at a time. So, once you start to see, you've got lots of lead time to make sure you've got some supply coming in.
And it's not free either. So how do you maintain a operating cost advantage, and how do you make sure when diffs blow out that you're not in the red? What gives you an advantage in that sense?
Yeah, I guess the advantage has been we had very low operating costs beforehand. So, we were call it a $12 or $13 OPEX and transportation together. I tend to lump the two together before we did polymer flood. So polymer flooding is added, call it $2.50 a barrel, but we're still in that $15 to $16 operating cost, operating and transportation costs together. So we're still very, very good for heavy oil.
Making money.
And part of that, I think we have very streamlined, operations. We're not scattered out all over the place. Everything is pipeline connected to main facilities. So, we're able to really, keep a handle on those costs. But that's what we do, right? They've got a great operations team. We've got great operators in the field they're focused on that all day, every day, and keeping those costs down and squeezing out every molecule we can.
And another advantage to heavy oil and then adding the polymer water flood is your decline rates get better. So what do those profiles look like across the field? How do you think about that? Who do you compare yourselves to, and what does that look like for you?
Yeah, I mean, there's no other company that I'm aware of that sort of has just enhanced oil recovery or just a polymer flood. So what I typically do if in our presentation, or we have in the past, I think it's there now, is we look at sort of some of the industry averages for Canadian companies. And an average for a small to mid cap company, typical decline rate is, call it to 20 to 30% per year. That's normal. That's the oil business, right? That's physics. But when you look at some of the majors, Sonova, CNQ, Imperial, all these guys, Suncor, theirs is more like a 15%. And that is because of the operations that they have in their SAGD and their mining. Yeah. And that's why they're free cash flow, like cows. Like,
it's a great business.
It's amazing businesses that they have. And so, ours is on that lower side, right? I don't know it changes every year, but we're in that sort of 5 to 10% typically on a decline rate, which is phenomenal for a company like us. That's why we're out, looking for other opportunities like that, because it just provides so much more free cash flow and limits the required capex every year.
And so the land package now, how many sections do you have, and how many wells?
So it's conventional, right? So it's not this, townships of land. I mean, our oil pools down in Atlee is probably 6 or 7 sections where those pools are. Mm-hmm. How many wells have we drilled? I don't know off the top of my head, but I'm going to say probably 70, 80 wells.
Okay.
In that southern Alberta, we've probably drilled over the last, call it 10 years. Mm-hmm. And so, that's been our main focus. We've drilled a few other wells, testing a few other ideas here and there. But that's been where most of our drilling's been.
Not many wells. And I think one of your value props is your LLR rating, your abandoned well liabilities are low. For the listener, why is that important, and why is it good for your business?
Yeah, there's a couple angles on that, and it has been. There's a couple mottos that we've lived by over the last decade, and has helped us survive, and also we think keeps us attractive. And there's some of my friends aren't going to love the first motto, but it's been just say no to gas, and it's tough. If you're tourmaline, it's not a problem. If you're CNQ, it's not a problem. Right. But when you're a small producer, natural gas in Canada is a very tough game. A tough game to make money at. And so we've shied away from that. But back to the LMR or the liability side of the business, that is something that investors have become more aware of over the last, I'd say 5-6 years. And when during the downturn, saw a lot of companies go bankrupt. And where did those wellbores ended up? They ended up back in the Orphan Well Fund, back in basically the government's hands. So it really showed a lot of people in the business and investors that, hey, this is something that needs to be, we need to be aware of, and there is money that needs to be spent here. So as an industry and government here in Alberta, they have addressed it quite well. And they now, they mandate that companies spend a certain amount of money every year cleaning up, the old wellbores, old facilities, this type thing. So that takes money though, right? So as a small company, I think our total liability for all of the wells we have is something like $6 or $7 million. Now most of those wells are still producing, so they won't be abandoned for decades out. But what it means, I think our minimum spend last year and this year is $200,000 or $300,000. So there's more money again there for growing the business, for paying a dividend, for buying back stock. We don't have a lot of wellbores in the system, and that has been again one of those mottos where we don't look for assets. We're very careful not to buy assets that have a lot of old wellbores associated with them. If the opportunity is unbelievable and the upside from getting more cash flow out of the ground, we certainly have the ability to do that. But it is something that we haven't done to date, and makes us a better company.
And at times, not having a lot of old wellbores makes it more appealing. If a different company were to come along and perhaps buy Hemisphere, it makes it a way easier process.
We think so. It also keeps operating costs down, because when you have these, wellbores all over the place, so there's usually some costs associated with those every year. Mm-hmm. But you're bang on. I mean, we do think at the end of the day, there's a checklist that just like we have a checklist when we're looking to acquire things, that larger companies have that checklist too. And it may not be a deal breaker, but it might be something like, hey, you know what? This is why we want these guys. This is just another reason why this is such a great company and great asset.
And in the beginning, did you tank your oil, and are you tied in now? How are you getting the oil to market as of now?
So For the most part, we've always had central facilities, and they've grown and gotten more sophisticated over time. But we basically get our oil to these central facilities. We get them to that oil to sales quality, and then we truck from there. It's about a 45 minute drive down to Tilly, which is where most of our oil goes. Not always, but it's usually where our best price is. And then we do deals usually with refineries down in Montana that, they'll take pretty much every barrel that, we can produce, and most of the Southern Alberta producers can get them.
So you get paid in American dollars, which is good, but do you hedge much of the production too? How do you think about risk in that sense?
So when we had lots of debt, we had lots of hedging. It's usually part of your debt requirements is to have some hedging in place. As we've been debt free for a number of years now. I'm not against debt, but we just haven't found the right thing to borrow to do. In the position we are right now, we don't have a lot of hedges. I don't think we have any hedges right now. If we do, it might be some floors or something, in the bottom. And it's really, you're just guessing. And the backwardation of the market that we've seen over the last year, you weren't hedging at very attractive numbers. So the hedge for us is we can just trim back on CapEx, cut costs where we can, and that's really the best hedging for us right now. If we had a bunch of debt, we'd have a different view on that.
This podcast episode is brought to you by JSG Professional Services, Canada's leader in pipeline construction management and inspection resources. JSG provides competent, qualified, and verified pipeline construction management and inspection resources, supporting Canada's largest pipeline companies from initial development through final execution. Whether your project involves new pipeline construction, integrity programs, maintenance pump stations, compressor stations, or inline inspections, JSG has consistently delivered experienced professionals to Canada's energy industry. Visit gsginc.com to learn more. And as of today, as we head into January, oil prices aren't looking great, which isn't ideal. It's pretty much impossible to predict pricing, but how are you forecasting your operations as a result? Are you going to lean into more polymer flooding? Where are you looking at for the rest of the year? Is it flexible?
Yes, it's flexible. We are just in sort of budget season right now. A lot of thought kind of goes into it in the fall, and then we finalize things through January. We don't typically drill a lot now in the winter, and then Q2 is breakup. It's mostly just a cost thing. It's cheaper and easier to drill at plus 30 than it is at minus 30. And, unless we need to hold land, or, we want to move a project ahead faster. This year, given 50, whatever it was when I walked in here, $56 WTI. The diffs are around 13, I think, today. It'll be a pretty cautious year. I mean, we'll spend some money. There's ideas that we will want to move forward, and there's some things we want to test. But I don't see, at least here in January and where we sit today, a lot of our investors, or even a lot of value to add, going out and trying to ramp up drilling and be aggressive in this environment. If anything, now's a great time to be looking at acquisitions and looking to acquire some things. So I would say, we'll definitely have plans. It typically is weighted more to Q3 and early Q4, just weather wise. And so we've got time. We'll see. And it's always easier if prices creep back up. Then we can add to the CapEx through the year. I mean, right now the headlines it changes by the minute, by the hour, and there's sentiment certainly is, I would say, bearish for WTI, but I'm one of these people. I'm more in the camp where I can still see, we get into Q3, Q4, barring all the, outside of all the geopolitical things going on, just at these prices, we'll start to see US shale production decline and roll over. We're probably starting to see that now, and that will change sentiment at some point in time. Probably not this month, maybe not Q1, maybe not even Q2, but we'll start to see. I would not be surprised if we saw, closer to $70 oil by the time we got into Q3, Q4 this year. May not happen. Don't plan, and I don't have to make plans based on that, but I wouldn't be surprised if we saw that. Oil's hard to find, and you can't just walk in and turn switches and pumps on and increase huge amounts of production.
For sure, which maybe we'll get into later on in the conversation. But before that, you also have a dividend you need to maintain, I think. So right now, with the concerns of oil prices, what is your payout ratio? And are you thinking about dividend increases? And how are you thinking about the dividend?
So we've designed, because we're small, one of the probably smallest dividend-paying companies out there. But our dividend is one reason why we have the great shareholder base that we have, and retail shareholder base. And so we've designed it to be, even in good times, the base dividend is relatively low. I think now it'll be somewhere around $9 million a year or so, and so it is there. I don't see any changes to that in at these prices anyway. And I always remind shareholders the one way that we have supplemented or added to our dividend is through some special dividends. In the last 2 years, we've done 2 special dividends through the year. And I'll reiterate it right now. Special dividends are special, right? And, we look at it as we're looking for ways to grow the business, short-term, long-term, and both. And if we see opportunities to use that money to do that, we're going to use that money to do that. If we don't see something and we're building cash, more cash than we think we need in the shorter medium term, then we will look at putting out a special dividend. If oil prices are kind of as expected, or in a good place, if production has been as expected, then it's one tool we'll look at to return capital. So we've done that the last few years. But again, special dividends are special.
And do you have a rule of thumb on the payout ratio for the company?
We don't really, it's been pretty conservative. If we look back at 2025, out of between 40 and 45 million of cash flow, we paid out, I think, 15 million in dividends. So it's and our capex was around the same. So we're well below,
taken care of.
Yeah. We don't. We've been even when prices were higher, 80, 85, and there was lots of people like, why don't you raise the dividend more? It's like, we're a 3,000-4,000 barrel a day company. There's a lot out of our control. Let's not get ahead of ourselves. And, it's for times like this when oil's 56 is why you don't want to get ahead of yourselves.
And another tool you have is share buybacks for increasing value to shareholders. How are you thinking about that nowadays with the share price? Without giving away your secrets, are you thinking about it?
Oh, yeah. I mean, we think about it. We talk about it all the time. I think at times we tend to buy back more stock when there is large drops in oil price. Usually, and unfortunately, we get more days than I ever thought we would, where oil price drops $3 or $4 or $5 a barrel. Someone usually panics, sells their stock, and we tend to be able to buy up some stock those days. So there's rules around how much you can buy and at what price and all that kind of stuff. But we're typically there on the bid and happy to pick up some shares, and at the end of the month, cancel them and try and add value for all the other shareholders out there.
So the last few days, it's been rough in the markets. In other words, it may be a good time to think about the buybacks for Hemisphere, given the uncertainty with oil prices and the fear in the markets, it seems like. I don't know if you think about it that way.
Yeah, and we do, for sure. I mean, we look at these times, again, you're not going to bet the farm on it, but, our view, we believe in oil, we believe in Canadian oil, and we believe in our assets. So this is a good time to, now the question is, will there be even a better time next week, or will this have been the opportunity to pick up as much as you can? That's always in the back of your mind, and just like every investor out there, and that's why you don't usually use all your bullets in 1 or 2 days. But absolutely, it's nice to have that NCIB there.
Risk-free way to add value to shareholders.
Yeah. I mean, it's just another way. I mean, one of our slides on our presentation just talks about, what do we get up every day to do as part of the strategy? Add value per share.
Mm-hmm.
And part of that adding value per share, obviously, is adding production, adding reserves, adding cash flow. But the other is erasing and getting rid of shares.
Which is good for you. I think you are one of the top insider owners of the company. So you've got some skin in the game.
Yeah. I probably the top. Yeah. I've got over 3 million shares, or 3 to 4% of the company. So yeah, it's, very, every decision that we make as a team, and I mean, that's just me as a whole, I think we're close to 20% as insiders through the board and management. So yeah, investors, it's one reason that investors, and some of our investors have been longtime shareholders. They know every decision we make. We're not always right. I mean, that's part of the business. There's risk, there's reward. Sometimes it doesn't work, but they know that with the amount of skin that we have in the game, the amount of shares and our, the amount of money we put into the business, we're taking every decision is combed over and very looked at very seriously.
Because the critic might say, I'm sick of this oil price volatility. I'm not sure where oil is headed. And there are other options in the market, capital light businesses and tech, and I can get nice return in the index maybe. So what would your response be to someone like that you've got a lot of oil in place, you're paying a dividend, and you're watching over the company closely?
Exactly. And it's not for everyone. We have it's a niche investor base. There's very few funds that come down to our market cap and our size. So our the niche of investor base is really it's retail. It's people that are comfortable in commodities. They're comfortable in oil. They're comfortable in small cap. And a lot of these investors, then they look at that and they're like, well, I'm looking for all that, but also you pay a little dividend. I mean, that's my dream come true. And you don't have any debt right now. Oh my God! So it's not for everybody, but for investors that that ticks the boxes that they have. There's quite a few people out there that do want to be in that game, and they. Not everybody, but most of these investors have been through ups and downs as well. They know oil prices go up and they go down, and the old saying, I'm sure you hear it on every oil guy that comes. I mean, the best cure for low oil prices is low oil prices, and it takes longer, for production to turn when you see $50 oil, but
exactly.
It does, and it will, and rig counts will go down, and we need a price in an industry that gives you a rate of return to go back to work and start to create production growth.
And so on the subject of waiting for the prices to turn, to what price level have you modeled the company out? Which price are you safe down to for investors who are worried about low prices? Is it 50, 40, 30?
Well,
is it secret?
I mean, it just comes out of the numbers. So, depending on what exactly it is that makes you feel safe. But call it $15 operating costs, right? And in Canada, and most of our land is crown, so it's subject to a sliding scale royalty. The lower the price, the lower the royalty. We have made money down to wellhead prices in the 20s. You're not making a lot of money. You're not but that's sort of when you have a lower, you're surviving. You have a low operating costs and a royalty that lowers as you go on a lower price. And for us, I mean, obviously there's some G&A. Call it $3 a barrel there. And then the biggest knock against Hemisphere is we pay taxes. And so, again, the less money you make, though, the less the tax part would be. But there'd be some tax on whatever you're making. So, what's the exact number? I mean, I
pretty low.
It's low. Yeah, then everybody asks, well, where's the dividend save? I mean, these are tough questions to know for sure. And then there's where is it safe and how long? I mean, if oil's touching $45 for a month or two, that's fine. If it's going to $45 for the next 10 years, well, that's different, right? I don't see that, when I look at the world and how much oil we use on a daily basis, and knowing how hard it is for, no matter what size the company is, how hard it is to find economic oil. So I think there's certainly a future for oil, and there is definitely a great future for Canadian oil, especially if we can get some more pipelines.
Yes. The company has zero debt, which is a favorable position to be in. Another way to grow is through M&A. Mm-hmm. Are you looking around at opportunities? Do you see other heavy oil assets around? What's on your mind these days?
I look every chance I have. And so I have other people on the team where it's in some cases their job. I've been hunting and looking for a long time.
Takes a while.
There's lots for sale. There's lots out there. It's hard to find really good assets. And we know we have something that's quite special. It doesn't have to be as special as that, but we are looking for things where if we're going to acquire it, we want to be able to see where we're going to add value to that. As a small company, there's no difference between being a 3,000 or 4,000 barrel a day company and being a 6,000 or 7,000 barrel a day company from a fund standpoint. Like, we're not going to get, these bigger investors coming in because we've doubled our production. Mm-hmm. We're going to have the same shareholder base, and that shareholder base has the same mentality that we do. We want to add value per share. So if we see opportunities and all these different things we're hunting for and looking for, that we make that acquisition, you can be sure that we believe, might be wrong, but we truly do believe we can add value to that.
One of the phrases on the company site is the best place to produce oil is where there is already oil. On that theme, there are other companies out there right now taking new technology into old place for enhanced recovery. Like, you guys, have you thought about that, to do kind of maybe a different strategy in an old play, not just heavy oil polymer flooding? Do you think
absolutely about that? Yeah. I mean, we would love more polymer floods, but yeah, there's not. We look at things other than that as well, whether it's, bringing a new technology into a play that maybe is uneconomic or sub-economic in verticals, or, but now you can do multilats into it, or you can do fracking, or, there's some other little new technology trend. We look at that all the time. But again, it has to be something that we really, truly believe we can add some value to, or test it first. Every year, we usually test stuff that we don't even talk about. Sometimes it doesn't work and you just move on. Sometimes it might work, or it's working, and you want to then, have the opportunity to pick up a bigger land position, or, capture some opportunities before somebody else does.
Because from the outside looking in a energy sector that's had a tough go the last 10 years, it would seem like the markets are mispriced and then there's lots of opportunity. But in reality, there's a lot of eyes on the market, and good assets are hard to find. So
there's a lot of smart people in this town and in this country.
It's not as easy as it seems.
And all you need is access to some of the data, and some fancy Excel spreadsheet modeling. So lots of smart geologists that sit in their basement combing through this stuff. Lots of smart engineers, and those are just people that are maybe not even working full time anymore. Then you've got all these great companies that are left that have great balance sheets right now that we're out competing with on a day-to-day basis, just scouring, looking for that next little tweak. Like, there's a hint. Could it be bigger? Could we unlock more? How big could this be? So it's what makes it fun. But it's not just, there's not low hanging fruit just kind of hanging everywhere saying, oh, well, all you got to do is just capture that. And, no one else saw it yet. Right. There's a lot of eyes on every asset out there.
But fortunately for you with a geology background, one of the best ways to identify values through good rock, so to speak. So how important do you think that is, a deep technical understanding in identifying new prospects and creating value for the company, that good old fashioned wildcatting, so to speak?
It's the only way to do it. Any other way, you're just guessing. I mean, it's, we've talked lots about it. There's risk in everything, even when you've done your technical analysis. So I would say, you can be lucky on stuff, but you've got to do your homework, especially now. I mean, or you're just blowing through capital, and profitability is not going to be there.
And so from a risk perspective, what are some of the risks that you're thinking about as we head into 2026? Is it the macro oil pricing? Is it other things that we don't talk about? How do you think about risk and identify it?
Well, I think certainly right now risk is macro. I think what we're mostly talking about is as an industry is where, where does WTI go here? There seems to be, a lot of geopolitical events happening around the world. That being said, we're still seeing $56 oil today, even with all these geopolitical events, happening at the same time. So that's certainly, I'd say the biggest thing we're trying to wrap your head around on the macro. But you can't let that stop you from continuing to look at the details, look at the M&A, look at the opportunities out there. So that's, we may have some huddles and talk about the bigger picture. But, most of our day is rolling up the sleeves and looking for opportunities.
And a good way to minimize risk is, like we said, technical excellence, but also on the capital side, just getting funded, more or less. So on that note, is it been hard to access funding now? Are you finding it difficult to find places to raise more money? Do you need to raise more money? You don't have debt, but do you go around the country?
I mean, we haven't raised money in 12 years or something, right? Like there hasn't been a market for sizable capital raises for a small company like us. So you need to either have the cash flow or find someone that will lend it to you. We've got, we've got a great lender. We're back with a reserve-based lender here in Canada now, and had been a great partner. We have access to a credit facility if we need it this afternoon, for the right opportunity. But access to capital is still very tough. We don't hear about financings happening. I think it's still, and I think it would be still very challenging. Now, are there people that, we have a decent track record? They know, could we go out and raise some money around the right opportunity? Probably. And maybe there's certain days we wouldn't be able to, but there are still people that look to invest in the space and make money. But it's not, I wouldn't call it easy. So I think you have to have that in mind. Like if you're going to chase something, you got to know how you're going to fund it without expecting to be able to just go to the market and raise it.
Has to make money.
You got to make money to survive now, and make money even at these lower oil prices to survive till we get a little higher price.
And so as a heavy oil producer in Canada, where do you think that your business fits in the next, say, 5 to 10 years with the way things are going in Canada and in Venezuela and the US? Are you seeing opportunity for heavy oil producers? Maybe more so. What's your thoughts?
Yeah, I mean, we are heavy oil in Canada. I mean, it's, we're unique. We're on, on the small side of heavy and cold flow. I mean, we use polymer flood, but I mean, we've got, in Canada, I think our biggest growth opportunities are in more oil sands, SAGD opportunities for big, hundreds of thousands of barrels a day growth. I am hopeful. I mean, I think we're still in the talking phase right now in Canada. I'm hopeful over the next 6 months even, we'll start to see some more clarity on some of these lots of projects, but in particular some energy projects. LNG is a phenomenal opportunity. We're kind of focused on oil, obviously, but I'm excited about it. I'm still hopeful. I still believe that we've got tremendous opportunity here. The Venezuela thing, that's obviously top of mind this week, and there's a lot of opinions out there on how quickly you can ramp up production. You have to remember, Venezuela is a lot like Canada. It's a lot of heavy oil, very heavy bitumen, oil sands. These are not small, just a little bit of capital to go get production back going. These are major billions and billions and billions of dollars. So I'm sure there's some things they can get back on, maybe it's a few 100,000 barrels a day. I don't know. I've never been or looked at the assets there, but to get back to that 2, 3, 4 million barrels a day that I've heard some people talk about, I do think that's a 5 to 10 year type thing, if it's possible at all. And so, Canada has then that opportunity where, continue to diversify our markets. There is discussion around another pipeline to the West Coast to tap more markets there. I think that's a phenomenal idea. I know it would cost a lot more, but I am Canadian. I grew up in Ontario. I spent a number of years here in Alberta, and I've now lived for quite a few years in BC. I'm a Canadian through and through, and I do believe some national security is important for our country, and having access to energy, Canadian energy across our country still would be a dream, and something we really should have and hopefully at some point in time. But we'll see. Let's start with at least one first, and access more markets there.
And so, speaking of risk, from an investor's perspective, from your perspective and capital allocation and the optimism on the Alberta MOU and all that sort of stuff, the other side to all that is that none of it gets built and things stay the same. There's some industry vets that would say, until something's in the ground, I don't see much value in this flimsy piece of paper known as the MOU. So how do you protect the company in that scenario where nothing gets built in, it's just words? How do you think about that?
Well, there's still tremendous value to be made. We
don't need
we're effectively full, but there is a bit more room, and there'll be a few more tweaks that they can do to some of these pipelines. But that's a lot of oil every day, right? And remember, we talked about that decline rate. So you take our, 4 million barrels a day, 4 to 5 million barrels a day, and you apply. I know a lot of that comes from oil sands, so that's a less of a decline rate, but we still have a significant decline rate. There's still a lot of oil that needs to be found and added just to keep that flat. Mm-hmm. So there's opportunity out there. There's opportunity for investors. There's opportunity for
just on decline rates.
Just filling what we have and going. I still believe our industry could be a growth industry. We can be part of the solution to many of the problems that we have in this country, that we just don't have the revenue to do everything that we want to do and pay the bills. We have solutions. Oil and gas is one of them, and it's probably one of the ones that we have the people to do it. We have the know-how to do it. Now we just need the political will to get the access to those markets. And I think that political will seems to be happening more and more as there's more turmoil closer to home. We seem to be getting more of that political will. I've got 4 kids. I keep pushing them all into engineering and finance, and hopefully they will be, following and working in this industry, even after I'm done for years to come, because it's a phenomenal industry.
And so you have a different perspective coming from Vancouver. Do you see maybe a shift in political will for some of the energy projects? Although the BC Premier is not supportive, you have an industry perspective. Do you think things are changing a little bit?
Oh, it's night and day compared to where it was even a year ago. I'm talking
Vancouver
federally. I would say more federally. Oh, Vancouver is a little different. I would say the people are more supportive of it. We have a government today, or a leader in BC that seems to change his minds on a few things. Seems to be against a pipeline today, but I think if the people see it as the right thing to do as a country, and people can see the benefit for them and their children and for their lifestyle. I don't think he'd be in government all that long. I think there would be a change to someone that is more supportive of that. I think it's we have to do something as a country. We can't continue along the path we're on, and I think common sense will eventually prevail in these. We build things to the best environmental standards in the world. I mean, I've worked a little bit of international work, and I have traveled in a few different places. I mean, people come to Canada to copy what we do here. Can we always do better? Yes. Are we always learning? And absolutely. But we shouldn't not do things in this country for resource development because we're concerned that we're going to do it wrong. So I'm hopeful. We'll see.
Like we said, it's January of 2026. So at this point, where does Hemisphere go? What would you say the company, where's the direction you're headed in the next 5 years? To the critics who'd say the junior energy market is tapped out and I'm not sure where the opportunity is, where's the company go from here?
We continue just to build a great business. If someone comes along and wants to have the assets we have to make their business better, so be it. That happens in this industry. But for us, it's just continuing to grow and build that reserve, build the cash flow, build the company, and build a good company.
And the drilling program may slow down this year with the oil prices. It may not if things pick up again, but you've got the pretty low-cost polymer water flood to do in the meantime, which is a great way to low-cost spend to keep the assets producing, I think is a good way to sum it up.
That's correct. Yeah. I mean, in these times, I think every company will be cautious on their capital spend for the year until we start to see, prices moving in another direction. But yeah.
I think that's a great place to wrap up the conversation. I really appreciate your time today, and a quick shout out to Clark Andrews at Haywood for connecting us.
Well, thanks again for having me.
Thank you. And unless there's anything else you want to say, we can
all good
end the formal conversation there. Thank you.